Good morning. This is Andrew Benioff with Lenrock Group and the Lenrock blog. Welcome. I'm talking to John DeRiggi today, who's the president and founder of Putnam Atlantic Properties. He provides, or Putnam Atlantic provides, strategic advisory services and principal investment in the multifamily and student housing world. John has almost 25 years of experience in structuring and closing transactions in excess of $4 billion of volume. John, thanks very much for joining us.
Welcome.
Really appreciate it. We want to talk about, today we've been talking about university and college investment development, etc. Specifically with you, I want to talk about student housing development. Most people, when you say university and real estate, they think of student housing first. Obviously many property types that go with it, but your area of expertise is student housing. So let's talk about working with both public and private platforms. How's the development process different under those two sort of scenarios?
So I have experience in both, right? I started with a student housing owner and operator that was public, that was private, eventually went public, and then back private again, and I've had an opportunity to work under both. From a fundamental standpoint, really no difference. You're still looking at supply, demand, economics. It's real estate 101. Where it differs primarily is in the cost of capital, the leverage, and the hold period when you're talking from an underwriting standpoint. So your cost of capital for a private developer is going to be typically a lot higher, pushing the opportunistic end of the spectrum, 20% IRRs, for example. As a public company, you're more focused on farming the FFO from that risk asset that you just developed over a longer time period, so you have a lower return propensity as well as a lower cost of capital. You're more geared towards FFO growth to meet your dividends primarily and other costs, which tends to be a lot lower. The other difference, major difference from an underwriting standpoint, is leverage. So as a private developer, you're maximizing leverage, 75, 80%. You may do that to start as a public company, probably not, but you may. But on takeout, you're leveraging way down, 50% and less, whereas with a developer, private developer, you're either thinking merchant build it, sell it before it's probably finished if you can, and then lever down if you're going to take the takeout loan to still, 75% of whatever that value is at the time.
Got it. That's wonderful. Thank you. Okay, so you've been developing and acquiring and investing in student housing for almost 25 years, as I mentioned. How have things changed in terms of the evolution of the housing product and the ability to obtain capital for both on and off campus projects?
Dramatically. So when I first bought for the firm I worked for our student housing product back in the late 90s, it was really the start of what is known as the purpose-built student housing market today, and the differentiator was how the units were leased. By the bed as opposed to joint several, bundled utilities, all-inclusive, but the product was for the most part garden-style, 3-story, stick-built, walk-up. They were apartments. That was an innovation compared to a dorm or a suite style. Limited amenities, no bed bath parity typically, no bed bath parity, very basic product. We're now what I'll call student housing 4.0, and each iteration has gotten better, better quality, better amenitized, and easier to use. Today they're building a product that's akin to any of the finest multifamily communities, amenities that are much more directed towards students, social media platforms, for example, and physical amenities that rival a Caribbean resort. Those units are also a lot larger. You have bed bath parity as a necessity in all of the off-campus student housing, particularly at and especially at suburban and more rural universities as opposed to urban, less so at urban. But now those units have gone from 800 square feet for a 3 or 4 bedroom to as much as 1,500 square feet. Capital is the other difference. When I first started in student housing, there was very little, if any, institutional capital. Today it's primarily institutional capital.
Interesting.
There are pension funds, private equity funds who are now pursuing the product as a less risky asset class, and buying at what's known as core plus type returns as opposed to more opportunistic returns 10 or even 5 years ago. That's the major difference.
Okay, interesting. So what do you look at when you're determining the strength or risk factors associated with a specific market? If you're looking at either investing in or developing the student housing?
So it's still real estate, right? So you have to look at the most basics, and that's supply and demand. Unlike, say, multifamily, student housing, supply and demand especially, is very easy to define. Your demand's coming from enrollments. So typically, the larger the enrollment, the more the demand. Not true in every case. Your true demand is how many students, how many heads are looking for housing off campus. As an off-campus owner and operator or off-campus developer, you're concerned with what's known as a capture rate, which in essence is the measure of the demand you need to capture to lease your property up. And in its most basic form, it's the total enrollment less the university's beds. What does that net demand give you, and how much of that do you need to capture? Taking it a step further, how much after all the purpose-built beds are filled do you need to capture? Generally, or not, the lower that number, the less risk in the market. So if you have a larger university, they tend to be less risky. So it really comes down to demand based on the number of students looking for housing off campus, and then supply, of course. Supply is also easier to quantify in a university market. It's a very defined circle, anywhere from as far out as 5 miles, although not typically. It's generally a 3-mile radius. It's very easy now with the free flow of information to find out what's in the pipeline. And then that just gets layered into your view of the net demand as supply increases. You hope that enrollment increases to keep pace with that. It's not always true, but enrollments are increasing for a variety of reasons, and eventually, we've seen this, that supply will get absorbed. So it really comes down to supply and demand based on the size of the university.
Interesting, interesting. Listen, John, it's been a pleasure speaking with you. Thank you very much.
Thank you.
Really enjoyed the conversation. This is Andrew Benioff for lenrock.com and the Lenrock blog. Thank you.